Okay, let's get to our speaker. Brian Beaulieu has been delivering workshops and economic analysis seminars in 7 countries to thousands of business owners and executives for decades. AHTD members have relied on the good folks at ITR to guide us through all the ups and downs throughout the years, and never more so than in 2020. We'll hear from Brian's pre-recorded keynote, and then he'll join us live via a Zoom meeting. And then for questions and answers for about 30 minutes afterwards. And you'll be able to ask the questions. And now, let's hear from Brian at ITR. Thank you.
Hello, I'm Brian Beaulieu, CEO and Chief Economist for ITR, and thank you very much for letting me join you in this manner today. I long for the days when we can all be back together, hopefully sooner rather than later, but we'll make the best of the technology we have available to us. We're going to be talking about the economic outlook going forward, but there's different aspects of that now, more so than usual. Obviously, the first one is COVID. So we're going to take a little bit of time looking at the COVID trends and more the economic ramifications of that going forward. Undergirding all of that is the government's response to COVID and what that means in terms of our economy near term and long term. And then finally, we're going to look at what the consumer is doing and what that means for our markets. We have a lot to go over. Some of it good, some of it not so good, in the sense of happy news versus not happy news. But it is the best that our best estimate of what is going to be going on. So let's start with the COVID. This is a slide that we look at all the time at ITR, not this slide. It updates every day, every business day. And what we're looking at are hotspots, new cases, and the more numerous the new cases, the redder the zone. And you can see right now that Wisconsin is the hotspot for the entire country. It was Texas and Florida, and then it moved to South Carolina, and now it's in Wisconsin. It seems to be a moving target. We don't know where it's going to go next. Out west, Salt Lake City is a bit of a hot spot right now. And other than that, though, the west tends to be quite calm. What we are seeing is there are a lot more cases. And you never know whether that's because the testing is better, there are more tests available, people are getting tested more frequently. Exactly why there are more cases beyond the normal assumption that we're losing our social distancing, we're going without wearing masks. At ITR Economics, because it is an economic issue that we're trying to get a handle on, we view what you see here as a natural disaster. It's not an economic disaster, it's a natural disaster. And like most natural disasters, there are economic consequences. And because this is a global pandemic, and obviously therefore stems from east to west in the U.S., there's going to be coast-to-coast issues. What I've highlighted here with these red diamonds are the states that are experiencing the most significant or are projected to experience the most significant drop-off in revenue. So this is one way the natural disaster is impacting the economics. California, Hawaii, Nevada, New Mexico, Michigan, New York, Kentucky, Alabama. Those states are going to be severely crunched for cash, not necessarily immediately, although it's beginning to happen now, but most of these states are on a 2-year cycle. So contracts that may have been let out already are going to be fulfilled. But they're going to be scrambling for ways to cut services, not release future contracts, that sort of thing, and raising taxes. Although raising taxes is not all that easy to do in a lot of these states. It'll take a referendum. But this is our way of showing that there's an unintended issue with COVID shutting down the states, and that is you shut down the state revenues, and that has ripple effects years into the future. These states aren't going to be out of the woods, fiscally speaking, until 2022. So there's cases, there's the fiscal issue, and then there's what we look at every day using CDC data, and that's the number of deaths in the U.S. Daily deaths are the red bars, and the cumulative total deaths in the U.S. is that orange line. Now, any number is too big of a number, granted. But for all the hot spots and the ballooning of cases, look, the deaths aren't climbing. What you can read into that is that the fatality rate is down, stemming from COVID-19. And that's because we've identified it sooner, and the medical community is much better at addressing it and taking care of the symptoms and bringing that fatality number down. This is where the rubber meets the road, really, in a lot of different ways, but in an economic sense, this is extremely important. Because if that fatality rate wasn't down, if the death total wasn't staying relatively benign compared to what we saw back in early August or certainly back in April, then we'd be more prone to seeing more governors shutting down their states. And that's the last thing that we want from an economic perspective. I'm not talking to you as a medical officer or a medical doctor, just as an economist. So to keep these states open is how we're going to keep this economy of ours moving forward. And our best shot at doing that is by watching these red bars and making sure that they're not going up. If they start to go up because of a significant second wave of COVID-19, then we may have to alter some of what you and I are going to be talking about. I don't know if you saw the webinar that Alan and I did, my brother Alan and I did a week or two ago, but we did a deep dive into COVID second wave trend probabilities. Now, here's the bottom line. No one knows whether there's going to be a second wave of COVID-19. Yes, we're dealing with some hotspots. That's not the second wave. That's not the one that has people afraid. And no one knows whether we're going to have it or not. You cannot develop a statistical model that's worth the tinker's darn more than 4 weeks into the future. So maybe have contingency plans for if there is a second wave, but spare yourself some angst and anxiety. Don't assume there's going to be a second wave. We're not. We're making plans where we know how we might have to adjust these forecasts, but why go there? In terms of the flu, you know, one of the big fears with COVID was that it was going to be exacerbated by the flu season. Well, the flu incidence so far for influenza is way below normal, below last year, and it's not hard to figure out. Seems wearing a mask and washing your hands frequently and staying away from people is a good way not to spread the flu around either. So, we can take that concern and pretty much put it off, take it off the table. The Southern Hemisphere didn't go through a massive flu season. That's also a good harbinger that we're not going to have to go through that same flu issue. It should be fairly benign here. These are all good things. We're assuming that there's going to be a vaccine 1Q 2021. We're also assuming that it's not going to be widely dispersed or widely taken for most of 2021. This is going to take time. The logistics of getting it into people's hands is a nightmare because of the nature of the vaccines that have been developed so far. So we just want you to know, we're not assuming some sort of miracle drug is going to make our forecast happen. We assume the consumer is going to make our forecast happen. For our Canadian friends, they clearly had this spike in deaths and it got them all sorts of excited, as it should. But it's coming back down now, most fortunately, and they're returning to a more normalized level of dealing with COVID-19. There are less populated states, fewer condensed areas. That goes a long ways towards being able to control COVID-19 in the population. So now we're going to leave that COVID issue, health issue behind, and we're going to talk about economics. Our world, our economic world for you and me is tied to the global scene. And globally speaking, we've got this nice leading indicator. See how that red line's going up? That's the G7 leading indicator. And as we're showing you, it leads by 9 months. So we have it shifted 9 months into the future. So you can see how past highs and lows have lined up relative to the blue line, which is world industrial production's 12/12 rate of change. The G7 leading indicator was turning up, and then it abruptly stopped because we were hit with COVID-19, and it fell like a rock in a pond. But you can see it's coming back up and it's making a V shape. That's important. It's important for our businesses. It's important for the economy. The V is, if you look back on this, it's fairly normal to see the slope of the ascent closely resemble the slope of the descent. And the fact that we're seeing it now is very encouraging in terms of some snapping back in the economy. Global trend is improving. We're seeing global leading indicators from Australia through the Eurozone, Mexico, the major 5 Asian economies rise. This had all tipped down into decline, 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 and now they're already back into rise. As the whole world gets stronger, we're going to get stronger. World industrial production here is in blue. The U.S. is in, obviously the other color, green, and we have the G7 leading indicator telling us that us, the world, going to be getting stronger going forward. You know, I like putting things in long-term perspective. So many people are looking at their feet these days, wondering about tomorrow or the next quarter or the next 4 or 5 months. Let's put some things into perspective, and that's what the next series of charts is going to do. And we're going to go through them quickly because we have a lot of ground to cover. But this is encouraging. This chart begins in 1820. And you're looking at the percent of the world's population that lives in extreme poverty. Green is people who are doing well. They're living above. They're not in extreme poverty. Red is the extreme poverty. And you can see how it's been coming down. This world is getting to be a better place. COVID has stalled a lot of things, but it will not deny us this trend. This is going to continue. It was in place before COVID. It's going to be in place after COVID. Economic fundamentals end up dominating these natural disasters. This trend is going to continue. Something near and dear to a lot of us. Child mortality is clearly on the wane. This is something to be celebrated. This is not going to change. Share of the world living in a democracy. That has stalled since 2000-ish, around 2001, 2002 is when it stalled. But you can see it's done that before, and then it comes surging back. This is also good. This is how more people are going to find more and more economic advancement in their lives. I'll debate anybody all day long. The purest form of economic growth is going to be capitalism, and you're going to find the best capitalism exists when you have a democracy. And that describes our system here in the United States exceedingly well. Global education continues to rise. 86% of the population now has a basic education or more. The more people have an education, the more their standard of living goes up. This through world wars and depressions and all sorts of bizarre things going on in our world like COVID-19. Spanish flu is in here. We will not be denied. So with that background material, let's take a look at some of the factors here in the U.S. that we think you can count on as being reality for 21, 22, 23, and beyond. One source of angst I'm trying to take away from you is whether it's going to be a President Trump or a President President Biden come January 2021. Look at the average per annum growth rate of GDP during these different administrations, red being for Republican, blue being for the Democrats. You'd be hard-pressed to draw a statistical correlation between who is in power in terms of the party in the Oval Office and economic growth rates. There is concern, we share it, in terms of what could happen with taxes if it's a President Biden and the Democrats also control the Senate as well as the House. We could be seeing some tax changes. And they could be made retroactive to 1993, which is what we saw Bill Clinton do, into January of 1993 in the 1993 Budget Reconciliation Act. So we looked at when the parties have been in alignment. And that's what these white bars are showing you. You can see it happens more to the Democrats, 4 times for the Democrats and only twice for the Republicans. But if you take the time to key in on that GDP trend line, you'll see that even when there is total political alignment, there's not a whole lot of change that goes on in the GDP trend. That's good news. Life goes on. We find ways to overcome, adapt, thrive. That's what we do. As long as you don't give up your desire to do that, we're going to be fine. A long-term trend you cannot afford to forget about, though, is demographics. Not only is the population of the United States getting bigger, but some states are doing well, some are doing okay, and some are doing not well. Texas, east and north of California, the southeastern part of the United States, that's where the people are going in droves. And that's where you're going to find the most economic growth. That's where it's really going to be happening. You want to be careful about the states that are in red or very pale, like Mississippi at 0.3, Illinois at minus 1.2, West Virginia at minus 3.3, and then the New England states. I wouldn't want to be buying a lot of land in those states. I wouldn't want to be buying a lot of business and thinking it's going to thrive in those states unless it's a particular kind of business that does well, even though people are moving out of the state. There's still so much, you see, that's in our control. To worry or not to worry, to plan on where the people are going to be or not. That's all up to us. To figure out with our tax accountants and our business advisors and our wealth advisors how we navigate any changes that are coming. That's what we do. And all along, we, AHTD, we're going to be feeding into this trend line. And yes, this is got a lot more bumps and grinds in it than does GDP. This is our world. It's a little bit more volatile than just GDP. But look on the extreme right-hand side of this. For all of the pain we've gone through in the first half of 2020, went through in the first half of this year, that's what it looks like. Compare it to the other periods. Been there, done that, been through worse. We're going to be okay. We've come through worse. What's going to be normal about the future? You and I are going to find a way to do business. You and I are going to find a way to bring to the customer what they want, what they need. They may not even know what they need. That's part of our job too. What's going to be new in the future is going to be very old. The consumer is going to consume. Government's going to try and run interference. People are going to complain. But we're going to grow. And there's some new trends that are going to help this trend line, this blue trend line that you see for the last 120 years, grow faster. We'll talk about that in a little bit. Retail sales, ultimate driver for our economy. You can see what we've been through, and you got our forecast over there. We're coming back. The consumer is already demonstrating to us that they're perfectly willing and able to spend money. And what we've gone through, as hellacious as it was milder than what we went through in the past. Come on, guys, we can deal with this. It's not the end of the world. They thought it was the end of the world in 2009. Remember at the bottom of the Great Recession? All the lamentation that was going on about how we've lost our prowess, how we're never going to grow again and all that. Look, we did. We do. That's us. When you're the world's #1 economy, you grow. Doesn't mean some things haven't changed, although they haven't really changed so much as they've accelerated. The brown line here is retail sales excluding e-commerce. The green line is e-commerce. And you can see how that's been accelerated in its rise. It was already gaining ground on overall retail sales. We all knew that. That's why we've been developing our e-platforms, et cetera. But it got a real kick because of COVID. And it's not going to give that ground back either. The stores that you've seen go out of business or the branches that aren't coming back into their brick and mortar spaces, it's because they were on the bubble anyways, and COVID laid bare their weaknesses rather than causing their weaknesses. The undercapitalized firms are indeed in trouble. This is the United States compared to the rest of the world, percent of world GDP. And you can see we're #1. And we haven't changed our mind one iota about this. We are going to remain the world's #1 economy for the next 100 years. We can say that because of our demographics. Yeah, the whole world is getting older, but you realize how young we're going to be compared to any of our major industrialized trading partners? We're the capitalist kings. Capitalism is going to rule. And I know we have our share of debt issues. We're going to talk about that, time permitting, or if not, you can ask a question about that in terms of the national debt, what it means, all in. But you know who's in even more debt? China. China. They're on the, as far as their star shooting across the sky, economically speaking, it's fading. Militarily, that's a different story, and they're going to compensate for their lack of economic prowess with probably more and more military prowess, and that's for other people to talk about. But they're a debt-laden economy, and they're going to be on the losing end of nationalism. Nationalism is happening worldwide. Nationalism really started gaining some momentum when President Trump put in place all those tariffs, and COVID just put it into a whole nother gear. 66% of American CEOs are saying they intend to bring some of their supply chain back to the U.S. or into Canada or into Mexico. And the smart play would be into the U.S. They're doing it for cost reasons, political reasons, for security reasons, protecting their intellectual property. You and I can be beneficiaries of that, or we can be on the losing end of it. You need to know that it's happening. And that nationalism is going to hurt China's growth, and it's going to accelerate U.S. growth. It's going to hurt Japan and accelerate U.S. See, all those foreign economies are going to be wanting to come here and establish either distribution centers or manufacturing platforms or assembly centers so that they can supply the world's #1 economy from within the world's #1 economy. You can expect that this nationalism trend is going to last throughout the 2020s. It's a trend that you can grab hold of and figure out a way to make even more money off of. So let's take a look at some of the nearer term drivers. Just as a reminder, we're going to be looking at rate of change. And as always, I'm encouraging you to run rate of change on your own businesses. Know where you are. Start with your own monthly revenue data. And we have this through July. And then you're going to take that data and you're going to compare it to 1 year earlier, July 2019. And you're going to see that that number is minus 4.0%. We're down 4.0% year over year on a 1/12 basis. Don't usually mention 1/12s to you, but I think you really should be looking at those for your own businesses based on some of the charts we're going to be looking at together. And look at this. Back in April and May, we were looking at minus 20%, minus 20.9%. So yes, we're still below year-ago levels in this data stream, but it's a lot less negative than it was. That's going to become important in your analysis and in your outlook. So then we're going to run a 3-month moving total, which is simply 3 months of data added up on a moving basis. We're going to compare the latest 3 MMT to 1 year ago. We're going to get a 3/12 rate of change. Now we know that minus 4.0 is above minus 9.6. That's encouraging. Then we're going to run a 12-month moving total. Smooths out any seasonality, takes a lot of the volatility right out of the data. We're going to run a 12/12 rate of change. And when we put it all together, our minus 4.0 on the 1/12 is now not only above the 3/12, but it's above the 12/12. If this is your business and you could see this and you could see how your business tied to leading indicators, you would know whether the worst was behind you or if it's still ahead of you. You would know it's a great deal of certainty, and that helps with your planning, risk management, budgeting, expectations from your teams. But it starts with knowing yourself and knowing where you are. As far as the leading indicators go, this is our primary dashboard of leading indicators for the U.S. And after COVID, it had all turned negative, all the way down the line. Now it's positive. We're back. With this many greens on our board, we know that unless the governors shut down their states or the federal government shuts us down, we're going to be rising. There's a lot of momentum indicated by this board. And I'm going to show you what the consumer is doing to further our expectations along here. But this is a beautiful sight. We're back. We're poised for rise. Retail sales. Because of COVID, we decided we needed something a little bit more timely than monthly data that we normally use. So we went out and we found this Johnson Red Book Weekly Retail Sales Index. So that bottom red line, about minus 29%, is showing you that department stores for the most recently available week, and so that'd be for the first week of October, was down about 29% from the same week 1 year ago. Department stores clearly have taken a beating during COVID-19 and still continue to struggle. Well, that's a kind of a duh moment when the governors tell us we're supposed to stay at home and they shut down the department stores as non-essential. Guess what? You're going to lay it in on them. But notice before COVID, they were the weaker part of this slide. They're the ones that are running barely above that zero line at times. Remember, the zero line is where you're running above or below year-ago levels. So they were consistently running below year-ago levels with but few exceptions leading into COVID. Overall, retail sales in the United States right now, that's that brown line, up 2.1%. So already, here we are, and this data is through September, no, probably August. We're up 2.1% from August 2019. Already, we're back. And the blue line showing you we never stopped buying. Even when they shut down the department stores, we continued to buy. See that blue line, which is discount stores, never broke through below zero. During the Great Recession, we broke through zero. During the 2000-2002 recession, we broke through zero with that blue line. It never even came close this time. The economy was broken in 2008-2009. It didn't break in 2020. COVID happened, a natural disaster, a disruption to the trends. But the economic fundamentals are still good. And that's what you're seeing with that blue line. The consumer has demonstrated to us their ability, their willingness, their desire to continue to consume. And that's meant to give you hope. And actually, more than hope, the reality that there's going to be upside activity for us all in 2021. How are they doing this? Well, you hear some commentators saying they're drawing down their savings, and technically they are. That green line is the level of savings in the United States, and it's at a little over $2 trillion, 2.4, $2.5 trillion. You can see how that green line soared up. That's the stimulus checks that went out and the spiff on top of the unemployment benefits. People weren't spending everything that the government was sending. They were saving it. Go figure. Now they're drawing it down because they want to continue to spend, but they have the wherewithal to do it. This is like economic battery power. It's latent buying that's going to be happening. And you'll notice ever since the Great Recession, that green line was going up. We had learned a lot of lessons in the Great Recession. So we went into this COVID downturn with more money in the bank than we normally see. That's incredible. That's strong. That gives you bouncing back power. Look at disposable personal income, which is after-tax income. It went up during COVID because of those checks, because of the unemployment comp being boosted. I've been doing this for a long time, studied a lot of economic history. That doesn't happen during a recession. That gives you an idea of the magnitude of the stimulus packages. This disposable personal income is a direct response to the fiscal stimulus. That's what the Congress and the President did. We've seen fiscal stimuluses before. They never moved the needle like this. In 2001, under George Bush, there was at that time, seemed like a big stimulus program sending money out to folks. It didn't move this needle. But this needle has moved. And now you can see it's coming back down toward a normalized level as opposed to, and this is fundamentally different, as opposed to climbing back up to a normalized level. Just going down to a normalized level. That's healthy. This is one of the reasons why we don't get overly concerned about the Congress and the President not getting together with another stimulus package. It's not like we need it on the disposable personal income side of things. It would be gravy at this point. And when you think about all the debts that we have gone into to make this happen, it may not be such a bad idea not to see that much more debt incurred to keep these trends artificially high. It may not be needed. Why also may it not be needed? Because we're going back to work. I know a lot of people like to focus on unemployment. We tend to focus on employment, but there's a uniqueness to this chart that we want to show you. Heck yeah, the unemployment rate went nuts. It went up to a level we hadn't seen since 1946. But look how quickly that unemployment rate is coming down. It's not like, you see those two other times where it gradually came down as those people were being gradually reabsorbed into the workplace? That's not happening this time because the economy was not fundamentally broken. The unemployment rate right now is 7.7% and coming down. The Federal Reserve Board is forecasting that 7.7% turns into 5.5% as of the end of 2021. Remember, we went into COVID at essentially full employment, running at 3.8 to 4.0%. So they're talking about roughly another 1.5 million people still unemployed by the end of 2021. You know what that means for you and me? It means that the window of opportunity to find people with the right attitudes and the desire to work isn't that big. We got 2021. Your training programs need to be top-notch. You need to be looking for the right attitude, desire, and see if you can't teach them to be what you need them to be on the line or in the office. They're out there. Right now, they're scared. They want a job. A lot of them do anyways. Bring them on board while you can, because this future is going to be one of rise. Single unit housing starts, a nice harbinger for the economy. That stalled out because of COVID. Open houses weren't happening. In some states, you couldn't even get your crews together to work on a house. It froze momentarily, but it's coming back. Why? Not only because of the economic of low interest rates, extremely low interest rates, low inventory levels, but we have the demographics to make this trend happen. This is a nice overview of the outlook through 2024. There's a period out there in 22, 23 we want to keep a close eye on. But we don't see any big dip in our future, not through 2024. And we have concerns about 22, 23 that could go more than sideways on us if we're not careful. So we'll keep an eye on that for you. But your expectations should be, wow, ITR is saying we've got some good rise ahead of us, and indeed we do. But it's not just ITR. This is the Federal Reserve Board's index. This is an index that the New York Fed puts together to get advanced indication of where GDP is going. And what they are showing us is that GDP reached its low in the second quarter of 2020. It rose in the third quarter based on this data, and it's going to rise some more in the fourth quarter, though maybe not as sharp of a rebound. So then the question is it going to GDP going to continue to rise? And the leading indicators, the consumer trends are telling us, yeah, it's going to continue to rise. It's going to take a while to come back. Those dots are our forecast points. We don't have GDP coming all the way back, recapturing all of that lost ground until the end of 2022. Takes a while to get it all back, particularly when you have the tourism industry, the airline industry, the energy industry seriously lagging behind the bulk of the economy. So it's going to take that while, but it is coming back, folks. Go back again to 2009. Think of all the doom and gloomers, people you know that said it's not going to happen. We're not going to come back this time. We can't. We are. Think of all the investment opportunities you had or could have made in 2009. Think of all the zombie companies that existed in 2009. Well, these interest rates are so incredibly cheap. Why not take advantage of this rise that is ahead, the cheap money, the pessimism, and see about maybe making some acquisitions to broaden your footprint or to go vertical in your business. Be part of the nationalism occurring. So taking a look at some of our markets. This is light vehicle retail sales. There's a lot going on this chart, so let me break it down for you. On the upper portion of the chart, you see that thicker green line. That's the 12/12 retail sales rate of change. And you can see that it is very negative at minus 14.5%. It's not as bad as we saw at the bottom anyways of the Great Recession. Both rates of change, that green line and the skinny dark line, are scaled on the left-hand side underneath ROC, which stands for rate of change. Notice how the 312, that skinny black line, is above the 1212. It's at 9.2 minus. So we're still, for the last 3 months, looking at, we're down 9.2% from 1 year ago. But that 312 running above the 1212 is exactly what we saw back there in 2009, 2010. It is a positive checking point in our world. It means, now drop your eyes to the lower portion of the chart, that thin black line, the 3-month moving total. It means that the 3MMT, 3-month moving total, has established its low. That is the low point for the COVID recession. We're climbing out of this hole. It's not going to be immediate climb out. This isn't exactly an industry that has been growing by leaps and bounds over the last 10 years. But as far as setting expectations, the worst is in our rearview mirror, and the best is out in front of us. And if that's true of retail sales, then it's going to be good news, obviously, for those of us involved with production. This is something I haven't shown you before because the numbers they're not frequently all that edifying, but this is U.S. light vehicle month-end inventory days supply. We're at 52 days supply, and that's a fairly low number. You have to go back to around, well, 4 years ago before you found something that low. And this trend line we put on there shows that, we were in a very favorable trend before COVID hit. That spike is because of COVID more than anything else. And now we're at very low inventory levels. Who's making what is shifting, obviously, as the traditional U.S. Big Three move out of cars and more into trucks or Jeeps. And we leave the passenger car market to others. But people are out there buying. They have the means and the motivation and the desire to do so. So it's no surprise that when it comes to production, you see on the upper portion that same 312 is running above the 1212 rate of change. 1212 is no longer actively declining. It's establishing a low above where we were in 2009. And that lower portion, the 3-month moving total, that also has reached a low. That's the trough. It's not going to get like that again. We're climbing out of this hole. It's going to take a while, but we have 2021 coming in above 2022 by about 16%. That may not be saying much considering 2020 is not going to be able to come in for the year as a whole above 2019, but it's a step in the right direction. In 2022, we have more growth. In 2023, we have more rise. That's what you should be planning on. That's where the trends are lining up. For wholesale trade of professional and commercial equipment and supplies, rate of change on the upper portion, 312. Not only is it above the 1212, but it's back above the zero line. It's at plus 0.4%. So we're already running above year-ago levels. This is a slice of our economy that got hit during the Great Recession, but generally doesn't succumb like other sectors will. And the fact that it didn't succumb, you don't see much weakness in the rates of change or the data during 2014, 15, and 16 is a good sign that the ongoing lingering weakness in the energy sector isn't going to be a millstone around this data series or this sector of our economy. 3-month moving total has reached its trough. It's above where it was 1 year ago. This is good. We're back. We're clawing our way back already. Trade of machinery, equipment, and supplies. I know I sound like a broken record, but the 312 above zero. Barely. It's showing that the 3-month moving total is only 0.1% ahead of last year, but you know what? I'll take ahead of last year, even if it's 0.1%. Positive checking point on the rates of change, so we've got rate rise going on in the data. Tell you what, it's over. The only question now is, how fast will we recover? Well, look at the last 3 troughs in the data. Look at the green line. It's the easiest one to see, that 12-month moving total. Pretty, the slope of the rise was largely informed by the slope of the decline, except the rise tends to have a slightly steeper ascent than the descent slope. That tells you a lot about what 2021 and 22 are going to look like, my friends. Some people, when they hear me talk like this, they say, "We love the fact that you're such an optimist, Brian." I'm not an optimist. I'm reading the numbers. I'm looking at the data. You know ITR economics. We tell you when the news is bad, unabashedly. But we also tell you when the news is this good. As long as you're not selling into the airline industry or trying to make a buck selling into the energy industry, I'm telling you, you're going to like where this is going. Non-residential construction is going to be a little bit further behind the curve. And it's one of the reasons why I think general purpose machinery production isn't as positive an outlook as you saw on the preceding slides. Here the rates of change, the 312 is rising. That's encouraging. Maybe your 312 is rising also. But it hasn't risen above the green line yet. So we don't have that very important checking point. Look at the chart here. When that 312 runs above the 1212, you know in your bones, you know that this is a bona fide recovery. That 3-month moving average on the lower portion, we think that's the low. When we look at the trend probabilities tied to the leading indicators, at ITR Economics, we think that's the low for the 3-month moving average. But man, I wish that, give me 2 more months and that 312 is going to be above the 1212. So when you see that happening in your quarterly report, that's what it's going to mean for you. You're going to know that the rising trend is really taking hold. There's momentum for additional rise. Let's take a few minutes and look at some financial markets. We're going to start looking at the stock market. This is the S&P 500, and that red line is monthly data except for the latest data point where we're reflecting the close as of October 18th. Now, if you follow the market every day, you know there's been a great deal of angst. Even if you follow it every week, there's been, oh no, what's going on? The tech stocks are falling. If you're following the market that closely all the time, seek counseling, okay? You don't need to follow it that closely. It really is not necessary. But for all the pain and all the angst that we went through, just over the last month or 2 months really now, that's what it amounted to. The first big drop you see as you go from the right side to the left, that's the COVID drop back in March. That's when everybody was wringing their hands, gnashing their teeth, wondering if the world was coming to an end. That's it. You see it right there. That's all of it. It was nothing compared to what we went through in the Great Recession. It was nothing compared to what we went through in 2008, 2009. It was less than we went through in 1987. It was less than we went through in the early 1980s. Yet you would have thought the world was coming to an end. It didn't. More's the pity. And I'll clarify that for you. But this is a very expensive market. When you look at the cyclically adjusted price-earnings ratio, this market is still very, very pricey. See, following the Great Recession, there had been a massive reset on valuations. Following the 2000-2002 decline, there had been a massive reset on evaluations. We haven't had that. You know, people will sometimes ask me, they ask my financial friends much more often, should we be buying Tesla as a stock? My friend will say, you know, Here's the deal. Valuations always matter. We just don't know when they're going to matter. Apparently they don't matter right now. Because if you look at Tesla per se, its market cap is greater than all the other car manufacturers on the planet. So if you think Tesla is really worth more than all the other car companies combined, then buy Tesla. Or buy Tesla because you think you can time it so you'll get out before valuations matter again. That's entirely up to you. But ultimately, there's going to be a reset. And what we're trying to do is focus on when that reset may happen. Some of you have heard us talk about the coming decade of the 30s and what that may mean for the stock market. But I want to bring that in a little closer to you and talk about the 20s. Because we haven't had the reset, and because of some other trends that we're looking at, we may be moving into a period where the stock market is not going to give us the outsized performance that we've had over the last decade. In the middle of this chart, you see those two big mountainous peaks there? Pre-2000 downturn, pre-2008, 2009 collapse. So there's essentially no growth from one peak to the next. I'm not saying it's starting today. Maybe it'll start in 21 or 22. But the odds of that lack of growth for an extended period of time are heightened in the 2020s. A lot of it's going to have to do with the value of the dollar, whether the world continues to have confidence in our ability and our desire to pay back our debt, how we look compared to China and our other trading partners. Never forget that no trend is going to go on forever. Money tends to flow from where it is to where it isn't. So much money has flowed into this market that it's really looking for the next place to go. Some of that's been in housing right now. That's why home prices are up 8.9% and climbing in the middle of a pandemic. It's crazy. Part of what's keeping this market afloat, in our opinion, is monetary policy. The huge amount of stimulus applied by the central bank, Federal Reserve. Most people understand fiscal policy just fine and the debt that was created. Most people don't really tune into monetary policy. This is the government creating all sorts of lending facilities and fiat currency. Fiat currency is money backed by nothing. What you're looking at here in the brown line is the 12-12 rate of change for the money supply. And the blue line is the 112 rate of change for the stock market, the S&P 500. Now go back toward the left there and you'll see in late 2010 that brown line reached the low and started to rise. 18 months later is when the stock market established its real low and you had that elongated period of rise. And then that brown line bends upward again and you can see 15 months later the stock market begins to rise again. And most recently, the stock market is responding to that gradual portion of rise in the money supply. See, the Fed was stimulative in their monetary policy before COVID-19. Where it starts to take off like our Falcon rocket is the stimulus. We haven't even come to that part yet. We're still waiting for that 15-month period to come. What's keeping the stock market afloat? You're looking at it, money. We're awash in this stuff. This is a liquidity-driven market. You're not going to be putting your money into bonds right now because the yields are so ridiculously low. Someday, this brown line is going to stop moving up like this. It will adjust. It always does. And when that happens, we'll be talking to you about what that means for the countdown for when the stock market goes through its apex. I can tell you right now, the 112 rate of change for the money supply is already reversed direction. So it's not like we're going to be going on like this too much longer. So why am I going through this with you? one, um, don't worry about the stock market. People are asking, isn't it out of kilter or just divorced from economic fundamentals? And the answer is no. It is very much reflecting economic fundamentals. Two, start thinking about alternative investments. If the S&P 500 and therefore the stocks that comprise the S&P 500 aren't going to be growing aggressively for 8 years or so, where else are you going to put your money? You're going to start putting it more into real estate, which we've been advocating for quite some time. Start thinking more about precious metals. Think about art. Think about alternative investments. And of course at ITR we have our Optimizer fund also. It's not a fund, it's a model that is run for us out of Bellwether Wealth in Nebraska. They, along with us, we built this model so that we could be protected from the downdrafts. We're not particularly concerned about that brown line reversing direction and the stock market losing steam or air, because we've got a model to take care of that. We'll try and tell you when it's going to be happening so you can protect yourselves also. So obviously not everybody's going to be using our Optimizer model. Stock market, it's floating on air right now, an air of dollars. This is a trend chart showing you interest rates. The darkest blue line is the 30-year fixed rate mortgage. You can see that's up very slightly from a recent trough. The lighter blue line below that is the 15-year fixed rate mortgage, and the red line is the Canadian 5-year mortgage. The fact that the lighter blue line is below the dark blue line is as it's supposed to be. That's showing you a rational yield curve situation. The longer the term to maturity, the more you're supposed to pay for the privilege of having people's money for that long. What's really noteworthy here is the delta between the Canadian market and the U.S. It's extraordinarily large. You can see historically, it doesn't stay this large this long. So what's going to give? Is the Canadian rate going to come down, or is the U.S. rate going to go up? I think the distortion is going to continue for a while, actually. The Federal Reserve under Chairman Powell has made it very, very clear. They have no intention of raising interest rates in 2021, that being the Fed funds rate, obviously, and the discount rate. They've even gone so far as to say they don't intend to raise interest rates in 2022. So any increases here is going to be driven by the market, the global market, not our Federal Reserve. So yeah, we're going to see some interest rate rise, but likely not much. These are historically low interest rates. Go back to what I said about the zombie companies, or just people who want to retire because they're just tired of the game. This is a great time to be leveraging up. U.S. economy is rising internally, nationalism feeding into that. Take advantage of it. Bet on our future while others are still wondering what the next 3 steps are going to look like. And you get so far ahead of your competition that way. In terms of the Canadian rate being so much higher, the moral of the story there is to our Canadian cousins, come on down. Buy some of our property at our interest rates. Make a killing. Demographics are better in the United States, and by the time you want to go home in January, we'll probably be allowed back into Canada from the United States. If not, I'm sure there's spots around the border you can just poke your way through. This is a good market. In terms of the debt, this is a telling chart also. Remember, this is driven by the world. And the world isn't afraid. And if you look at the yield curve, the world isn't afraid. The yield curve is where we take the 10-year Treasury yield and we subtract from that the T-bill, 90-day T-bill rate. And that's called the yield curve. And when the yield curve, that blue line, drops below 0, it's a surefire signal that there's a rocky road ahead. Those gray periods is recession. So go below 0, you know you're going to be in a recession. The reason we don't use this as a adamantly anyways as a leading indicator at ITR is because the time is too variable. Even over this short history, you can see how variable the timeline is. We need something that gives us more certainty in terms of the time, but it is a good supporting character. And you can see that the blue line is already heading up. I've told you before, and so bear with me while I repeat it for anybody listening for the first time. The global bond market is smarter, it's bigger than the stock market. It's smarter than I am. And that blue line going up is telling you and it's telling me that the bond market sees the world improving, sees the world healing, it sees us getting on with our lives in this economy. Who are we to fight the bond market? You know, we can insist that we are right and invest wrong, and we'll lose. You make money by going with the market, not by betting against the market. This is also the bond market telling us that they haven't lost confidence in the U.S. Doesn't mean they won't someday, but so far they have not. What we do is we looked at the T-bill rate and the 10-year Treasury, and we compare both those numbers to our major trading partners. We know what's the normal spread. Either we're above, like we are against Germany, or we're below, like we are with China or any number of other countries. And when that U.S. rate goes above a normal relationship, that'll be an indication that the bond market is starting to lose confidence in us, but we don't think that's going to happen for years. We don't think that there's going to be any inflation for years, for one thing. The Federal Reserve is adamant about that as well, if you read their reports. Yeah, I mean, I'm not talking about we're not going to go up to 2.5% inflation by 2022-23. We probably will. I'm talking about problematic inflation. That isn't going to happen likely until we're on the other side of 2023. That means interest rates generally stay low, and it means that paying for this mountain of debt that we've accumulated is generally easy. But as interest rates start to go up, and they will, because of inflation, because of demand, then rolling over this debt of ours in the United States becomes more difficult, more costly. So you're going to see maybe one of two things, maybe two things happening, not simultaneously though. One, I think you're going to see the world looking at China, at all their debt, their lack of ability to grow because their export markets aren't as vibrant as they used to be. China is more involved in the Middle East as the U.S. vacates the Middle East. And I think the bond market may look at China and say, you know, these numbers aren't adding up for me anymore. There's too much debt, too many questions. So United States, we love you even more. And that'll help keep our yields down. But I'm concerned, as are my colleagues at ITR Economics, that we've reached a terrible moral hazard when it comes to the fiscal and monetary stimulus that has been invoked because of COVID. Because make no mistake about it, it's been epic. Never seen anything like it in sheer magnitude, percent of GDP. What have people learned? Maybe people my age haven't learned this, but I think a lot of the younger ones have. They have learned if things get really, really bad, the government's going to send me a check. Government's going to make sure the banks can't foreclose on me. Government's going to take care of me. So that's what happens when things are really, really bad. But now they've had a taste of that honey. So maybe next time it's just really bad. Not really, really, just really bad. And we want the same thing. And then time after that. I think that leads us into an era of modern monetary theory. MMT, as it's called, says that the government has a moral obligation to borrow as much money as it possibly can to make sure life is as fair for as many people as it can. Everybody enjoys the right standard of living, whatever right may be, whatever fair may be. And when they have the obligation to do so until that activity starts to create inflation. And we don't see serious inflation for years. That gives us years to get into all sorts of mischief along this score. This is going to be interesting and worthwhile watching. I know you get our quarterly reports, but I want to offer you access over the next 90 days to these leading indicators, to the financial markets, and our analysis. If you text TR space offer to 33777, you can access our trends report on demand. What that means is you can now get it on your phone. There's an ITR app for your phone, and an indicator comes out. We're going to analyze it, populate it, and you can see what's going on. You have no reason not to know what's going on in the leading indicators and in your own company. This is going to be a good future. I like where we're going. We're going to climb up, out, and be stronger and better. And we're still leading this world. Thank you very much for listening to this part of it, and I look forward to the Q&A session with you shortly. Thank you.
Good morning, Salt Lake City. Good morning, Team Virtual. And good morning to Brian. Can you hear us, Brian?
I can. Good morning.
We love those last words that you had. It's going to be a great future. Brian, you have hundreds of AHTD members hanging on your every word here in the room. The signs that we know that people are enjoying, or at least hanging on every word. The devices have been up, snapping pictures of the screen, and I can hear and feel people furiously writing all the notes. So in Salt Lake City, you'll see that we have some floor stand microphones. Now is the time for you to queue up and ask Brian a question. Team Virtual, please take to the question area on screen. Start typing in those questions. Mara is the moderator and will absolutely get your questions answered there too. As you're starting to think about your questions, I do want to make a plug for the member benefit, the sponsored member benefit that we have. We do have our monthly ITR 30-minute webinars. And so those are a benefit. I want to certainly thank the sponsors that we have for that. Interlinks, Secomea, and Smart Vision Lights have sponsored this program. So once a month you can log in and get that. We had our first one on Wednesday, so please don't miss out on that. For anyone on your team, as you are a member company, any one of your team members or employees can log in to hear that. So please don't miss out on that. You'll want to register for that. All right, Mara, why don't we hear about what's going on with Team Virtual? Brian, we're going to queue up some of the first questions. Mara's going to read off who is asking the question and what company they're coming from.
Okay, so my first question is from Jürgen Siebold from Lutz. And he's asking, what caused the rapid gain of the euro versus the dollar in July 2020? And where do you think the exchange rate between the two currencies is headed?
Okay. It's hard to know what makes the market move in any given direction at any time. Likely it was Europe was looking better than the U.S.
We'll just give it a couple minutes to try and shake it out. It's now that I realize that I did forget to take my blood pressure medicine this morning. Hey, Uncle Brian, good to see you. If you would, please, let's just start back at that question of what Jürgen had asked. Mara, if you would repeat the question that we had just posed to Brian.
So again, it was what caused the rapid gain of the euro versus the dollar in July 2020, and where do you think the exchange rate between the two currencies will go?
Okay, can you hear me this time?
We sure can.
Okay. It's hard to know what's going to make the currency move in a short period of time like what we saw in July. Usually it's multifactorial, but more often than not, it's some money flow driven by a shift in confidence or a look change. Doesn't tend to be all that long lasting. You ask what it's going to be like in the future. Depends on the time frame that we're talking about regarding that future. But let me go broad answer on you here in terms of a long term. There's every likelihood that the U.S. dollar against the euro and really against the trade-weighted basket by which we measure the dollar is going to remain relatively strong for the next several years. However, we think that the way the U.S. has gotten itself out of this COVID hole and the fact that it's fundamentally different than the way the Europeans attacked the problem is likely going to cause a shift in that relationship. I don't know if it's going to take place in 22 or maybe it'll wait till 23, but we think you're going to see a fundamental trend reversal where the dollar is going to be no longer generally strong against the euro, but likely to be weakening against the euro. And it'll be a function of the debt that we've gotten ourselves into as a government.
Excellent, thank you. We do have a question here in Salt Lake City. If you'd say who you are and what company you're from.
Good morning, this is Kevin Jones. I'm from Ectobox. We're an IIoT systems integrator. The question is around the reshoring from China. I think you said that was about 66% of companies that have elected to bring production back to the U.S. and Canada. I think that number was correct, and please correct me if I'm wrong. And also, could you speak a little bit more to how you have identified that value and where you see the trends going for that reshoring? What's really driving that?
Sure, absolutely. A number comes from a survey that was taken by another organization, not ITR, and I don't remember whether it was Reuters or Business Week. Off the top of my head, I'd have to go digging for that. And they were saying that part of their supply chain will be coming back to U.S. or Canada or even, and the reasons are myriad, from quality concerns to just-in-time issues to protecting intellectual property, cost functions. All of those are factoring in. To be sure, to the extent that U.S. manufacturers are in China to service the Chinese market, they're likely to stay in China, or what a lot of them are now doing, it seems, is going to Vietnam, because in Vietnam the cost of labor is less and the education of the labor force is high, and in China. You can expect that trend to generally continue in our view. Here's a little fun fact, as I think of them. Given the demographics of China, they're going to lose 100 million workers every 15 years. So you're going to see this hollowing out in their ability to provide the labor force for which they historically built their power, their economic power, which is why they're moving very aggressively to robotics and artificial intelligence and automation. And how successful they're going to be at that is, of course, an open question. But there are fundamental shifts going on that are not to China's benefit. We are clearly, and we have that data, there's the Reshoring Institute, and that's the source of that data. And you can go to their website and look it up. The numbers of companies that are coming here. There's reshoring, which is when someone used to be overseas and they've come back to the United States, and then there's onshoring, where they're coming here for the first time. And both of those trends are accelerating, and they're bringing with them jobs, in a lot of cases manufacturing jobs. But also call centers are coming back here as well. Pharmaceuticals are highly sensitive to what's going on, and they're likely to be coming back into the United States. They're heading the list right now, as a matter of fact, in terms of probabilities of major change in that supply chain.
Thank you. As Mira is going to get ready for some more team virtual calls, folks in Salt Lake City, plenty of microphones for you to step up to so I can see you for the next question. Mira, who do we hear from?
The next question I received is from Chris Gilson from Gilson Engineering, and he is asking about the asset tax. He says, do you believe this is inevitable?
I don't like the word inevitable because it's an absolute, and I attempt to refrain from using absolutes, but I think it's the trend, shall we say. And it's one that scares me. I understand taxing income, that's been the way of our world since the Civil War. But when they start taxing, well, assets now get taxed. You have property taxes and you pay a tax on your car, right? But they're talking about, at least in California, a much more fundamental tax, and that is taxing your wealth. And California even wants to attach your income for 9 years after you leave the state. I'm not sure how they would pull that little hat trick off, but you're going to find as we go through the rest of the decade, yes, the trend is going to be for governments to become ever more creative of how they're going to attempt to help the wealthy part ways with their wealth. And they get to define who's wealthy. Fortunately or unfortunately, depending on which side of that equation you are, I suppose.
Thank you. Mira, and the next question.
Yes, we have quite a few still here. We've got one from Corey Foster from Valen. I'm sorry, I don't know the pronunciation. This one's about business taxes. He asks, what is your take on increasing or decreasing taxes on businesses, especially the largest of them?
Okay, the background for this is I have Austrian economic tendencies in my thinking, and that means I find government to be at best a necessary evil rather than a helpful partner to businesses and the economy in general. The question is well timed. I was just looking at a KPMG study that ranked all the countries of the world based on their effective corporate tax rate. In the United States, our effective corporate tax rate is 27%. That's higher than the global average, and it's higher than the European average. In fact, if you look at our major trading partners, there was only France was higher than us. Everybody else was lower than us. So one way to answer this question is raising it when we're already toward the higher end of the spectrum is only going to increase corporations' desire to keep their profits offshore rather than come back here and acknowledge those profits. They're going to exacerbate that trend. Two, we've seen corporate taxes go up, we've seen them go down. We see that they don't make much of a difference beyond distorting some of these microeconomic factors that I just talked about. They don't make a difference in the macroeconomic trend. The economy is still going to grow. In fact, corporate income accounts for about 1% of GDP, and it's been a remarkably stable number, so it's not like they take a disproportionate amount away from businesses. So it's, again, it's a different perspective on how you look at this. I don't mean to argue both sides against the middle. It's just, I can see why they want to come after corporations, because individuals are paying a lot more than corporations are, and a corporation is like a faceless entity. So you're going to go after corporations, and particularly in this day and age when capitalism is getting a black eye, it seems, left and right. You're going to attack the capitalists, whether that be the corporation or the people who own those corporations. Overall, though, at the end of the day, it is not healthy if the government starts consuming too much of our tax dollars, because there's no ROI. In fact, when you're as indebted as the United States is as a government, you tend, for every dollar they take in, it turns into less than $1, as opposed to seeing some sort of positive multiplier in the economy. It tends to go the other way. So it's not helpful. It is probably the trend. I'm not going to say inevitable, but if Mr. Trump is no longer president, it is probably even more likely that you're going to see those corporate taxes go up, which scares me even more along those lines, by the way. And it's not a corporate tax per se. It has to do with the death tax, the estate tax, depending on which side of the equation you're on. Vice President Biden wants to take away the step up in basis that we currently have. And that would be very painful and very distorting, and it's not something that most people are even aware of or seemingly want to talk about. But that's one of those hidden, really big deals in his campaign promises, that if you got a Democratic Party-controlled Senate, that'd be probably the most worrisome aspects of it that I could think of in terms of his proposed tax changes, is that lack of step-up and cost basis.
Excellent. Thank you, Brian. Thanks, Corey, for that question. And let's take a question here from Salt Lake City. Who are you and where are you from?
Of Advanced Controls and Distribution and AdCon Engineering. We're based in the Pittsburgh area, an automation distributor. One of our large markets is metals. Can you touch on where you see the metals business, both, obviously steel and aluminum, over the next several years?
First, go Steelers. Second, where I see the metals business, are you talking about it? Back to you before I answer. Are you talking about in terms of the price of the metals, or what aspect of the metals business are we referring to?
The manufacturing, Brian, the Nucors of the world, the Alcoas, metals production.
Yeah, well, okay. As part of the reshoring and onshoring phenomena, the metals industries get even stronger in terms of the longer term. In the shorter term, though, we got two things working against us. One, the airline, which is a big consumer, you mentioned the aluminum, which is very important to the aluminum industry, is on its heels deep into 2022. And as far as other metals, we have non-residential construction that is just beginning its decline. It held up well, but it is going to be going down. Just think of office space as a good example. And that's going to last into 2022. So in the near term, you're going to see a paucity of demand, relatively speaking, relative to pre-COVID activity. But longer term, I see both factors going the other way, turning back up, and probably at a fairly good clip. And given our propensity for wanting made in the USA and using USA materials, it's going to be a good rebound on the other side of that valley that we have to go through in some of these markets.
Excellent. Thanks, Lou, for that question. We all know Green Bay Packers have it handily. Mara, who else do we have on Team Virtual?
Well, 2030 seems to be on the minds of a couple of different AHTD members. So this question comes from Kevin Stahl from Lakeland Engineering and Gary Harrington from Drossbach. So the question is, you and Alan have both spoken of a Great Depression coming around 2030. So are there any changes in thoughts due to the pandemic? And are there any updates on your previous 2030 predictions?
Yeah, we thought about whether we should bring in the timeline of the 2029 peak in the economy before we slide into a Great Depression, because of all the debt that we have gone into as a country. Certainly that's been accelerated. We're at percent of GDP levels that we've never seen it. This is worse than what we saw during World War II. So that had us going, whoa, this is outside of the parameters of what we thought was going to occur. Maybe we should bring in that timeline. But we took a deep breath and we went back to our studies, and this is what we came up with, that it's not a function of the size of our debt. It's a function of the world's willingness to lend us money. And as long as they're with money, then we can carry this debt. And what we're doing is setting up these algorithms so that we can monitor our 90-day T-bill rate relative to our major trading partners and a 10-year yield on our government bonds relative to our major trading partners. We know what the normal relationship should be. So we're setting up this algorithm so that when we get outside of normal parameters, it trips an alarm, if you will, in our system. And we can go in there and look right away, what's going on? Why is the world charging us more money or that much less money than we would expect to see under these circumstances? It's when they stop believing that we will either want or have the ability to pay them back that I think the size of the debt becomes an issue. And we don't have anything that makes us think that it's going to be our near term. That yield curve discussion that you saw earlier is part of that analysis. And remember, the Great Depression is also predicated on demographics, and that hasn't changed. It's predicated on Social Security and other entitlement programs continuing to be a problem. There, Vice President Biden has suggested imposing a very hefty tax to help solve Social Security. And there, it pays to remember that you can talk about a whole bunch of things on the campaign trail. That doesn't mean they're ever going to come true in the reality of being in office. That would be very hard to get through the Senate and the House, in our opinion, because you would get a whole bunch of people very, very angry with you if you were to start raising taxes that significantly and or benefits, which is what you would have to do, one or the other, both. So we don't see those problems going away. We certainly don't see healthcare costs being mitigated by anything either candidate is proposing or anything that we can foresee beyond those candidates. So at the end of the day, our analysis was, no, just leave that stake in the ground where it is. The only thing that has changed in our outlook is we used to say we expect, because this is America's decade, that stock market will probably give us a good run in the 2020s. And we're not nearly as sure about that as we used to be because of the COVID aftermath. We've seen all this fiat currency flooding into the stock market without profitability having risen for 7 years. This is totally unjustified levels of activity. This is a liquidity bubble, in other words. And unless there's a reset of significant proportions, this bubble is going to ultimately lead, we think, to either a bigger boom at the end or a bigger bust out there in 2030, in which case you don't want to be anywhere near it, or it's going to lead to a series of tremors that ultimately gets us into a decade for stocks after we reach this near-term apex created by the liquidity issue. So how we get there has changed, and I'm sorry for the long answer, but the net result, the timing of the net result hasn't. We're still not looking forward to the 2030s.
Thank you for that. Thanks for that,
Really,
Brian.
you're thanking me for that?
Thanks a whole heck of a lot. But Kevin and Gary, thanks for typing in that question. We've got a question here in Salt Lake City. Who are you and where are you from?
Yep. Joel Braun with C&E Advanced Technologies. You briefly mentioned the energy segment. I'm curious on your thoughts moving forward, both fossil and renewable energy. What's going to be the trigger points for a rebound in that sector, and is it a election-dependent segment?
I'm not sure I understood the last part of that. Is it an election?
Yeah, is the election going to determine the rebound in that energy segment?
Oh. No, I don't think so. At the end of the day, it's basic supply and demand that drives that. The change in party at the top bolster the non-fossil fuel sector over the fossil fuel sector, but we're still a fossil fuel-driven economy. We are energy independent, and it would be foolish to throw that away without a great deal of planning and a great deal of thought, because it is a tremendous natural resource.
What is going to get us back to a healthy energy sector is time. You know, we've produced so much oil. We continue to produce so much oil. It's more than we can absorb here in the United States. So we need global economic recovery besides U.S. economic recovery to sop up all this excess supply that is currently out there. We got to get the inventory levels down. This is refrain from ramping up production, and then you get a rebalancing of the supply and demand. Our own expectations are that it's 2022 by the time that happens, whether it's President Biden or President Trump.
Thank you. And
By the way,
go ahead.
if I may, just for another moment, I heard another conversation yesterday at a board meeting I attended where someone was saying that in 8 years, there won't be any more internal combustion cars available for sale in the United States. Then this was a very learned person, and I'm thinking, oh my gosh, this, you know, that's not the trend. Internal combustion engines have lost 1% of market share over the last year, and that means they're at 93% market share today. It's going to take a lot more than 8 years internal combustion engine to go away, and we know because you can study the data. If it wasn't for the tax incentives, they wouldn't even be gaining that much market share. There's just no cost basis that makes it worthwhile to go there unless you're about environmentalist or you're looking for some tax help along the way. So it's not going to be that fast of a process until we're on the other side of probably 2020 to 2028. Then it'll start accelerating, is our view.
Thank you. We'll have time for one more question. Mira, do you have one for us queued up?
Okay, I do have one question, but I was told that it's Valen. So
Valen.
I did.
Corey, it's Valen.
So
I hear
thank
you,
you for
brother.
that.
We got you. Valen.
So our final question then is from Pamela Kahn from Bishop Wise Carver. And her question is about growing sectors. She said, what sectors are growing because of COVID-19?
Medical and testing devices are growing because of COVID-19. Legal community is growing because of COVID-19. There are things that are growing because of COVID-19 at an accelerated pace, like the e-commerce industry. Grocery stores, we're doing a land office business, and everybody's supplying our grocery store land office business. The chemical industry in the U.S. saw some spiff because of a supply chain disruption that's related to COVID-19. Housing market is benefiting from COVID-19. Lawn and garden equipment is benefiting from COVID-19. The paint industry is benefiting from COVID-19. Boats, motorcycles, trailers, campers. We have the money, we can't go anyplace, so we're still finding a way to spend it. We're spending it on our homes, we're spending it on fun stuff that we can do locally. Those are doing land office business right now.
Wonderful, thank you. Well, let's wrap up the Q&A section here. Brian, thanks so much for getting your presentation recorded, coming online early and testing with us. Everyone appreciates being able to ask you a question.
Thanks for letting me participate this way. I know I was originally supposed to be out there in person, and COVID things happen, unfortunately, still. So I'm sorry that I could not be there in person, but I'm very grateful to you that you let me be with you in this way. I want to be there. I really want to be with you in person and be shaking hands too. Now let's go crazy. Let's shake hands.
Let's do that. You love it when Brian starts to talk about getting crazy. So that's wonderful. Brian, we know that we have you on our speaker slate for spring meeting 2021 when we meet in Ponte Vedra in April. Everyone, let's hear it for Brian.
Thank you very much.